I'm Brendan Yurik, one of the founders and the CEO of Electric Royalties. We are a young royalty company focused exclusively on those energy metals really required for the transition to clean energy. There are 9 different markets, 9 different metals, relatively small markets today, but exponential growth forecast moving forward. We've already got 20 royalties. We're really targeting those deposits within North America, Europe, and Australia that could fit the bill as a domestic source of supply for these metals, including lithium, copper, nickel, and all those. We've got cash flow. We've got about 4 million cash in the bank. We just announced a partial royalty sale for 4 million cash as well. So we're on a pro forma basis looking to have about 8 million cash in the bank. And that's more cash than we've ever had to date. So it's an exciting time to be cashed up in this type of market and looking to keep growing here as we move forward.
Brendan, thank you very much for the introduction. Good to see you again. We did an interview. We spoke, I think, in the beginning of March, so 4.5 months ago. It's been a wild time in the markets. Commodity prices are crashing around our ears. The US dollar's gone on a tear. Do you want to just kind of comment on the last four or 5 months for what you've been up to and kind of how it's kind of impacted, being impacted by the kind of the wider events in the market?
Yeah, well, it's a little bit crazy, right? Our share prices has been absolutely beaten up, and we should be a pretty good bet in an inflationary environment, just from the ends of a royalty company, protected against capital cost inflation. We don't have to put up those development costs, capital costs, protected against operating cost inflation, because we have no operating costs. These are scarce metals. You can't print more of them, like they can money. And even lithium prices are still up over, around 400% this year, though. And our portfolio is heavy lithium. The crazy thing is, our share price has cratered, but we've just been having good news across the board. 150 million was just raised to put one of our lithium assets into production by Seymour Mining. Just in the last month, we had a PEA come out on another one of our assets. 47-year mine life. We're expecting on the base case, it'll pay about US $3.5 million a year once production. And so, we've had just good news coming out. So, theoretically, our value should be much higher than it was even a month ago. But, tough markets all around. So, I think it's going to present an opportunity really for growth. Copper's been hit. A lot of these metal prices have been hit, but it's so short-sighted, in my opinion. Zinc stocks are at like record lows right now. Metal across the board is much lower than it was this time last year for inventories, but prices are plummeting. And I know the supply side hasn't gotten better, and that takes an average 15 years development timeline for each of these assets. So we'd have some eyesight on that happening. And so
the stock market is often a quite responsive reflection of the mood in the market. It deals with quite immediate events. It deals with these very quicksilver sentiments, and we've seen that in the sell-off. I completely agree with you that the long-term supply fundamentals of many of these metals are critical, and of course we can see those demand drivers in the kind of the medium term, but in the short term we are dealing with a sell-off as there's so much uncertainty about the economy. Is there a recession coming? What's the impact of COVID on China? And then, of course, we've got the kind of the strong dollar, which is pushing all the prices down. So there are these immediate short-term impacts, but I think perhaps, I want to just ask a couple of questions. First of all, you've done a capital raise. You've raised
less than that. To date, our company's only raised, even going back to our private days, about 10.5 million or so. And we're going to have about 8 million cash in the bank here, on a pro forma basis in a month. So we've been very good building this portfolio. We're very frugal with our cash. Our G&A burn is very, very low. So, theoretically, we could survive for the next 4 or 5 years. But really, this is an opportunity, I think, for us to go out there and get royalties on assets that, quite frankly, 3 months ago, were otherwise unavailable, to us, or would have been much more expensive.
Can you tell me a bit about that capital raise? Who did you go to, and when did you do it?
Yeah, so we did that a couple months ago. Quite frankly, our share price had already come off quite a bit. We ended up raising that money at 30 cents. They had a warrant attached to that as well at 45 cents. We got an institutional investor in that took up a large chunk of it. That was Canaccord that led that financing. And so that was it was a much different experience than our previous financing, just doing that on our own. But yeah, Canaccord's been good. They raised that money very quickly. We decided not to oversubscribe. We were fully subscribed, but quite frankly, our last financing before that was at 40 cents. And we didn't want to raise too much money at these prices. We're glad we did now because we have a bit of cash. And as I mentioned, alongside that partial royalty sale, I mean, the crazy thing is, if you look at it right now, our market cap's around 23 million. We've got 4 million cash in the bank. We've just announced this deal, which puts an implied valuation of 6 million on Seymour Lake. And that really leaves, 13 million enterprise value for you guys to, sparse across the rest of our 19 assets. So it's a little bit crazy right now.
Tell me about Seymour Lake. Who did you sell what was that monetization event? Could you just kind of describe that a bit?
Yeah, sure. So we picked that royalty up. It's a 1.5% NSR. We picked that up last year, February of last year, for $1 million in shares at the time. And, right now we're monetizing a piece of that. So we're selling 1%, 1.5% for 4 million cash to a private group called Lithium Royalty Corp. Now, part of that is, we picked that up. Our portfolio is pretty heavy lithium. We have a number of assets like that we picked up last year. They've raised, I believe, over about $70 million for Seymour Lake since just in November of this past year. But for us, it's still, 4 or 5 years at least from production. We are a little bit heavy lithium, and we just feel that we can use that cash to keep growing, keep adding diversification, and get into stuff that's, maybe a little bit earlier to cash flow.
And what do you see as the landscape in the royalty the royalty scene at the moment? Is it? Do you still? Is there a lot of competition for near-term assets? Because I can completely understand that the junior exploration companies are struggling for equity. The equity funding has pretty much dried up in the last few months, and so I can imagine that there are some distressed juniors looking to enter that kind of royalty discussion. But for the exploration place, but for the near-term assets, for the kind of 1 to 2 years to production, is there still a lot of competition for those royalties?
Yeah, I think if you look at production and near-term production, really PFS to FS level and operating, if you're looking at sizes of, let's call it 20 million, that's where all the big money is competing. So you'd have all the big private equity groups, funds with, 300, 400 million in the bank. So it's really competitive, even the big royalty guys, they'll definitely play in that range. And so there's a lot of competition. What we've been trying to do really is be a little bit sneaky. I mean, we haven't really had much competition. We're the only group out there targeting a lot of these different metals. We did the first graphite royalty financing ever just a couple of years ago. I think we're the only guys that get really pumped up about tin these days. But all these different clean energy metals, a lot of them we don't have competition on, but we're trying to be a little bit sneaky about it. Really get in right before PFS level, I think, is really the optimal time from a value perspective. There's no one else really servicing that market. I would say the same thing would be for, groups that maybe are a little bit smaller. They don't have that asset that's going to be attracting a national buyer like China, just because it's a little bit smaller, like the copper deal that we just did. But we like those assets, things that actually could make it in production. They don't have such a big production footprint. They're either underground or, fairly small or fairly simple, smaller operations. So, we like that from a permitting perspective. Something that we can actually help, attract some investors to actually put into production, and a junior could actually do, but really in that PFS to PEA level, right? So where at least investors can see the economics of it. We have a better sense. They usually have a technical report out that's really nice for us to be able to go through as kind of an initial due diligence step. But really, yeah, that's kind of where we've been going. And the nice thing is you're getting into assets that are, potentially 3 to 4 years from production. But, payback on those would be like kind of 1 year of production. And so it's much more accretive than, say, you going in and paying, essentially 7, 8, 9 times cash flow. to get into a typical producing asset. But that's another area I'm excited about, because I think there is a market below $20 million, where a company might need 5 million here or 5 million there, where royalties are great, because we're not making them tie those payments to any specific timelines. When they're making money, if they're making better money, we're making better money with them. And so I think there's going to be opportunities for us to go a little bit further, down the stream, targeting kind of smaller deals, just because there isn't that much money out there for that.
When you say that you're targeting kind of the PEA to the PFS kind of bracket as your kind of your core focus, and you mentioned kind of 3 to 5 years, or 3 to 4 years from production, and you mentioned permitting. That's a critical time, isn't it? Do you see ESG and permitting as a soft risk or a hard risk?
Oh, I'd say it's a huge risk. And I think if you look at the projects that we've gotten into, none of these are mega projects, Las Bambas or, Jadar in Serbia, and so you see some of our competitors, they get into a lot of these big multi, you got tech and BHP kind of thing, running that operation. And it's going to be just a, massive open pit or something. Most of ours are reasonable, they're pretty small footprints. We like stuff that's, like our nickel asset, past producing underground mine. Even our recent copper acquisition, it's a, copper oxide project, relatively smaller footprint. And so we like those. I think that's part of it is reduced risk on permitting. We also choose our jurisdictions pretty carefully. If you look, we are heavy in Canada right now, but it's really Eastern Canada, Quebec, not too much in BC, because it can be tough. We don't have any projects, in California in the US, for example. Our recent deal would be in Arizona. We have our zinc mine is in mid-Tennessee. Look, a lot of the decisions that we make, a lot of the choices about jurisdiction, types of assets that we want to get into, a lot of that revolves around permitting. ESG is also definitely a factor of that. You're looking into that already, as part of permitting, and, stuff like, do they have hydropower and good access to, cheap renewable energy is always kind of an easy one. But yeah, I definitely think if you look at our portfolio, you'll understand that is a huge risk, and we see it as a big risk. And so we do allocate, what assets we want to get into appropriately, but we definitely take that into consideration.
And how should a retail investor, how should a kind of someone in the street how should they ascribe a future value to a royalty that's at the PEA or PFS stage? I mean, it's when a royalty is in production, when a asset is in production, you've got a royalty. You can see that there's a cash flow multiple that's applied to these companies. I mean, we were talking about it earlier. Kind of about 10 times for the junior end and kind of up to 20 times for the bigger royalty companies. So if your royalty is generating, let's say, $1 million a year, if it's sitting within a small company, it might you may be able to ascribe, let's say, $10 million of value to the company. How does it work? How does it work?
Yeah, well, that's a great point of the value growth that I think investors don't necessarily see. It's like Seymour Lake, we're selling that a year later at pretty much a 6x valuation that we paid for it. Now lithium prices have gone up, but a lot of money and work has been going into that asset. And so, yeah, look, I mean, if you look at, say, just Battery Hill, and I won't make a prediction in terms of when it comes into production, but it is the only manganese district in North America, not really being developed for the EV space. So I think it has some impetus to it. But once that's in production, on the base case, based off their PEA, we're expecting about, $3.5 million US. So let's call that, kind of roughly 5 million Canadian. And so, yeah, on the juniors, you're looking at about 10 times cash flow. And so that would imply, once in production, whenever that date would be, an implied valuation of 50 million, potentially for just that royalty. And so, when you look at right now, I think we have 13 million enterprise value really spread across 19 of our assets. And so, yeah, when you have royalties like that in that portfolio, you can see that just, down the road a few years, just by waiting, because we don't have to put up any more money for that project to go in production. Really, that's all done by other parties. We have no holding costs. Yeah, you can start to see that if you could just see 3-4 years out here, the portfolio should be growing in value incredibly as these things start to come in production. And, I would say that because we've been targeting this, kind of 3 to 5 years out, we've been around for 2 years now. And so a lot of the assets we actually got into, 2 years ago, we're looking forward to entering production over the next kind of 12, 18 months. And so it takes a little while longer to do that, but now you're going to see our portfolio really start to do a lot of the heavy lifting for us. And then us just being accretive, continually picking up good deals as we go.
So what are the assets which are most likely to come into production? I mean, this is one of the difficult things about a royalty company is that there are so many kind of projects. And is it OTA? I mean, is it the lithium there? Is it Sayona? Is that the next thing to come in production? It's not
I would imagine so. I mean, they've acquired the Canada lithium mine, which was really the only producing lithium mine in Canada, and OJ sits right next door to it. And so that's a much easier, path forward to production. Basically, the plan is to blend ore from OJ to ramp up production at that mine. And from my understanding, it's really the ore body of the Canada lithium mine that's been kind of the biggest challenge. And so the OJ ore body as a source of blended ore for that seems to be really the only solution that I've heard about. And they're fully funded. They've raised, over 150 million in the last month alone to basically put that in production in 2023. So that's definitely a candidate. I would say Graphmata is another potential candidate to be the next one that comes into production. It's a past producing graphite mine, operated for over 20 months continuously, had all of their product qualified with off-takers, big step in that space. And so they have everything there. They just upgraded their resource. And their long-stated plan was to upgrade the resource ahead of bringing it back online at double the production capacity they were previously. So,
but in their resource statement, the one that they just put out, they also talk about the next steps, and the next steps they're talking about doing geophysics and more drilling. It seems to me that they're actually now more interested on developing a bigger project rather than bringing then doing a small scale restart.
Well, I think part of that's always, they have a pretty decent resource there already. They've got all the mining infrastructure, having their product qualified with off-takers. Like I said, that's a very, very big step in the graphite space. Look, they want to build a bigger resource. It doesn't cost very much to double the production capacity at a lot of these graphite operations. And, we've looked at quite a few, but the magic number seems to be kind of like 20 million in terms of additional CapEx to up your throughput by 2. And so, it makes sense, right? to go be able to capture those economies of scale. And so, there might be a little bit more of a delay in terms of, getting it back. But once it comes back in production, it should be a much nicer paying royalty. Obviously, if they double their production, our expected revenues would be doubled as well.
Yeah. Remind me what you're looking for to, what's your kind of cash flow multiple or your cash flow that you're looking to get from the Graphmata kind of on the old base case?
I think we're looking at about $1 million would be our target.
Yeah. Okay.
Graphite pricing is still a little opaque. I mean, from my, from our discussion, and it matters. It really matters by mine. Yeah. But from our discussions, we believe graphite prices are still up over about 60%. Even over the last kind of 6 months here. So, all these prices are moving. Lithium markets are definitely got the most spotlight. But I think as you move forward here over the next few years, as these markets become more visible, more liquid, more regulated, people are going to start to understand. I mean, these prices are already going, and it's driven by supply. Everybody talks about the demand side, but really the whole growth here and pricing moving forward will be the supply side. Because it's just, we haven't had much money going in, and it's, like I said, average 15-year development timeline. You can't really overcome that period of underinvestment. But, it's much easier to forecast demand models based off of, macro, economic forecasts and all that. You can't really do that for the supply side for mining. You have to have intricate knowledge of mining and the deposits out there globally.
Yes, and approach it with a healthy degree of skepticism.
Yeah, well, that's the thing too. I mean, those banks always expect every project to make it in production, and there are definitely not that many out there. I'd say we hit maybe 1 for 10, 1 for 5 would be maybe optimistic. So, look, mining is more difficult than people realize. Metallurgy is definitely a bigger challenge in our space, and so that would be probably between permitting and metallurgy. I mean, you're looking at probably 50-60% of our decision matrix getting into different royalties.
Okay. And what's going on in Madagascar at the moment? It's always been a strange environment. It's a strange operating environment in Madagascar.
Yeah, and it's one of those. It's an outlier in terms of jurisdiction that we're interested in. But there are, for tin kind of occurs in Tasmania, it occurs in the UK. Graphite, Madagascar just seems to be a pretty special place for graphite. You had Mick Davis recently came in for a large investment. There's a couple other operators in the country. It's got its challenges, I think, like a lot of places. Probably not too dissimilar from what you face in Chile in terms of water shortages, that type of thing. But for graphite, we felt like Madagascar is a pretty special place. We feel like they can operate there. But obviously, it has challenges like operating, anywhere where they have issues with water availability. You
can't choose where you find your deposits, I guess.
Well, that's the thing, right? If you look at global production, China's producing 60% of graphite, 60% of tin. They produced over 99% of MSM, manganese, for the EV space. As of 18 months ago. Indonesia, nickel, 60% or so. Cobalt, 60%, comes out of Congo. Yeah. So, look, the first international trade was set up over tin mines, 2,000 years ago. And so I think that's going to kind of come back as a funny theme here in the near future. But look, you kind of have to go where the metal is. We're really targeting those deposits, like I said, in these jurisdictions, North America, Europe, Australia, but we've already got royalties all in and around the only producing lithium mine in Canada. We've got a royalty on the only vertically integrated with the only primary zinc producer in the US. We've got one of two tin assets in the US that might be potentially economically viable. And we've got the only manganese district really in North America being developed in the EV space. So we're already, we're already getting the onlys and the best, of these assets in those jurisdictions. And like I say, you can't print more of these. They take thousands, millions of years for these deposits to form, and they occur where they occur.
And your zinc royalty at the moment is paying out at the moment. Sort of, what's the zinc price? It's still, because you've got a tiered payment, don't you? At different zinc prices. It's above 90 cents that it kicks in. Is that right?
So above 90 cents it kicked in, and between 90 cents and $1.10, it's a 1% royalty, and anything over $1.10, it's a 1.4% royalty. Since we acquired that royalty, it's been healthily above 1.1. Zinc prices were as high as $2. They're briefly just a few months ago. They've come back quite a bit, but we're still expecting that it's going to pay out about $500,000 this year, our portion back to us. We actually have an option to increase that, our royalty percentage, to double it. And we have that option coming out this August and next August, whereby, essentially we pay what Sprott paid. We brought Sprott in on that deal, minus the cash flows they've actually received for that portion of the royalty. So it would cost us about $4 million or so, $4.5 million. And we'd be looking to do that, probably next year. Just given where our valuation is right now, it would be really a heavy weighting towards that one asset. But yeah, if you go back to our kind of enterprise value of 13 million, and you have, our Battery Hill royalty, which we talked about, you have this royalty, it's already paying us $500,000 a year. You could, if we were getting a junior type, valuation, let's call that, maybe 5 million, a 10 time valuation. And you still got, another 17 assets to really kind of dive through in our portfolio to fill out that 13 million enterprise value. So,
so tell me about the Battery Hill royalty.
Yeah, well, it's like I said, it's the only district really in North America developing a manganese asset for the EV space. The metallurgy is really advanced. They've been working on that for about 3 years now with a very good group called Cometco. And if you look at the other peers out there, there's only really about 5 developers globally. These guys, I believe, have done the best job on metallurgy. So even though they just put out a PEA, metallurgy, like I said, one of those really kind of key decision points for us, much more advanced than that. But it's going to have an initial 47-year mine life. They used a pretty conservative base case pricing. So when I say, we expect once in production, be about US $3.5 million a year back to us. That's on the base case. They included an upside case that was about 70% higher than that. And I think prices, quite frankly, will be, much different when we move forward.
You got a 0.5% royalty on that?
We have a 2% gross revenue royalty on that asset. So it's a nice one. That's our biggest royalty. And it's gross revenue. It's right out the top. There's no deductions. So it's very easy for investors to calculate, what they expect our revenue to be on an annual basis. Would be expected production for that year. You choose the metal price, and then times by our royalty percentage.
And who is running Battery Hill?
So there's a management team. A guy named Martin is in there right now, and they've taken it this far. They've got a PEA in there. I believe that they can, take it a little bit further down the road. But ultimately, my guess is that this space is going to be run a lot like mineral sands is. Where you have a big group come in like a Rio Tinto, basically dominate the industry by owning, the 2 or 3 top assets globally. And I would definitely count this among them. It's long life. Like I said, metallurgy is very advanced, good jurisdiction. And I think that's exactly the, type of deposit groups are going to be looking for offtake from.
And is it a, so who owns it? Is it a private company? Is it a
junior company right now? It's a junior public company owns it, called Manganese X. And
their market cap?
They've been kicked in the teeth as well. I think it was as high as 100 million. Last year they're about 25 million themselves right now.
Okay, and the CapEx figure that they kind of put out. Sorry, the CapEx figure that they put out in the PA was roughly.
I have to go back and check. It was definitely a few hundred million. I believe it was 350, 400 million. But ultimately, where their valuation is right now, it wouldn't make sense to build it, but I don't expect that a junior is necessarily going to be putting this into production. I think really you're going to see the OEMs, the end users start to move down a little bit into the supply chain. They're going to have to, otherwise they're spending hundreds of billions of dollars. That's the crazy thing, right? Building out these plants, they're going to need all these metals. You can build a plant quicker than you can build a deposit. And so, I know from discussions we've had with a few groups, groups like in Korea, where you have OEMs actually looking at, grassroots, even greenfield stuff. And I think that's only going to start to pick up as they really start to understand what the supply side looks like. Because, everybody else can afford to be kind of day to day. If those guys are spending hundreds of billions on plants that are going to need these metals, they're going to have to be a little bit more proactive. And so, I think that's going to be an exciting space. Now that they have economics on Battery Hill, I'd expect partnership discussions start to, pick up rather quickly.
Yeah, great. It's a nice model. I like the precedent of your Seymour Lake deal, where the project advanced and you were able to trade part of your asset. So just let's break it down then in terms of your market capitalization minus your cash minus the carried implicit valuation of Seymour Lake. Could you just talk me through those numbers, please?
Yeah, sure. So right now, as of taping this, our market capitalization is around 23 million Canadian. We've got 4 million cash in the bank. We just did a financing. We had a little bit of cash left over. And then we have the implied valuation of the Seymour Lake deal at 6 million. And so beyond Seymour Lake, we've got 19 royalties, right? So pro forma, we'd have 8 million cash. We've got market capitalization of 23 million. And that would imply an enterprise value of 13 million. Sorry, go ahead.
Well, the enterprise value of 13 million, but let's assume that you've still got $5 million of valuation you can ascribe to your
MTM royalty or Middle Tennessee Zinc royalty. Yep.
Yeah. So that takes you to 8 million. Just as a kind of, this is just as a kind of a thumbsuck building blocks of value. So yes, you've got an enterprise value of 13 million, but you've also got this kind of a look through value block from your zinc royalty, and therefore your remaining however many royalties it is. So
then we'd be at 8 million, on a theoretical basis here, and we'd still have another 18 royalties to go to ascribe value to, and you'd have Battery Hill would be one of those. If somebody said they could buy Battery Hill for 8 million today, and a few years down the road they're going to receive 5 million Canadian back, every year for 50 years. I think that'd probably be a good comparable. And that would mean the rest of our 17 assets you're kind of getting for free. And we've got Oche, like I said, just raised 150 million, looking to put that into production. We talked about Grafmata, past producing graphite mine, looking to bring that back into production, double the production capacity. We just picked up our first or second copper royalty. Fantastic mine. They have a PEA out, already have about 500 million pounds of copper in the ground. Our money can get them to feasibility, within a couple of years. We still have our vanadium iron ore development project, Monetization, probably the best iron ore development project in North America. They had a PEA, they got Glencore as a partner. It already had a kind of 40-year mine life. And we've got Seymour Lake. We still have part of that. We've got Kansas, another lithium royalty. They've raised about $20 million since November as well. And then a number of other development assets that we can talk through at length. But the top 10 asset in the U.S. So right now the valuation just doesn't really make much sense. And so it's a great opportunity for people to get in and buy.
You say that, but the big issue is that timeline. It's the time value of money, because really what's going to cause a change in the valuation of electric royalties is going to be some kind of trigger that ascribes more value to a given royalty. I mean, as I come back to say that I really like the precedent that the Seymour Lake deal did, which was a kind of a clear, what's the figure you said, a 6x, in less than 2 years.
It's basically trying to help to your point, build these building blocks of value. It was a valuation thing, partially as well, just kind of showcasing the market. Hey, look, we're not getting any value for this, but there is value for each of these royalties. And so, that is a tool that I think, we definitely would use again if we're not getting that value. So, I think investors should stay on their toes, because if we aren't getting properly ascribed value, which, it's very easy to argue we aren't today, for some of these assets, we might decide to jump the gun a little bit, not have to wait till cash flow. Maybe we'll monetize a piece of that today, at a much fairer valuation than what the market's given us.
Who looks at the valuation properly? Do you have a sensible conversation with other royalty companies? Do you feel that they know how to value royalties? Do mining companies know how to value royalties?
It's a good question. I typically, the way that we like to do deals, and my favorite place would be go create new royalties. And in those circumstances, you're identifying an opportunity where maybe they need capital, maybe your capital as a royalty would be a better alternative than, say, equity for that group. And so you're going in, you're trying to fill a need. And, for what number they need is kind of, what it ends up being, right? So I don't really usually negotiate on an NPV basis. That's kind of the go-to. Traditionally groups will go, hey, we need to get an NPV of, X per dollar we invest, or, you got to have a 20% RR. We typically don't, go in and do that with groups, but it's always a part of it. Look, I think it's on a case-by-case basis. I do talk to the other royalty guys. We've got multiple, we've got Vox as a partner, we've got Globex as a partner. I've spent my entire career before this, basically advising the junior company side. So we'd be going around talking to all these different royalty groups, for a long time before that. But, again, it's interesting, right? I mean, metal prices in our space, in the clean energy metal space, took off incredibly this year. And so, you have to have a little bit more kind of eyesight in terms of where pricing is at, where it could be going. The biggest average annual price increase for gold, I think, has been 20%, 25%. You've never seen something like where lithium, up 400%. And, a couple of months ago, everything was up 100%. Cobalt was up 75, tin was up 100. So, I think value it's a little bit tougher, and it really matters, when you get in and what price tag you're using. Interesting.
Yeah. And for the retail investor to kind of see a trigger, do you think they're looking for feasibility studies? Do you think they're looking for the capital to be raised? I mean, did the capital being raised for Sayona and the OTIF, was that the bounce in your share price, or was that unrelated?
No, we haven't quite got it. Look, I think part of it is, I think there's a couple of catalysts. But one would really be us getting enough size where we can attract institutional investment. There's a lot of money that's looking to get into this space. We're kind of that perfect vehicle. We're one way you can get exposure to the entire clean energy space, but you have to be of a size where an institution come in, put a $5 million check in, and they don't go over 10% ownership. So, once we get over that, I think that'll be a big part of that change. But no, look, I mean, they had some good news. Sayona had some good news on OJ on the metallurgy about a month and a half ago. I watched Sayona's market cap go up by 700 million. Those went up by 30 times our valuation, and I think we stayed even that day or went down. So no, it hasn't translated into that bump for us. I think investors want to see cash flow. That's why we're going to be looking at bringing in some immediate cash flow as well, not necessarily waiting for these assets to come in. I think the co-investment model that we use with Sprott is a great way to minimize our dilution, get into the right assets. But picking away at some stuff that's a little bit smaller maybe as well. But I think cash flow is really what people understand the easiest. I don't have to describe our 20 assets, the future potential of cash flows. But the nice thing is we'll be cash flow positive once OJ Graphmata comes into production. Like I said, our G&A is very low as a royalty company, and we're not on the hook for paying anything moving forward to take these assets ahead. Whether that be exploration development or just cost of holding them. So yeah, we wanted to get in, build a portfolio of assets where a lot of that value is going to be done by other parties and built, and that's really the accretive nature of those deals. Yeah, I think investors right now really want immediate cash flow. They want us to get to a dividend position at some point here sooner rather than later.
So you mentioned that you were kind of pursuing that cash flow route. Can you unpack that a bit for me with a little bit more information on that, please?
Well, I think perfect in this market where you have metal prices plunging. Groups that are going into operation, in construction. Typically those guys are going to need more money. It just it's one of the things, right? So I think in this type of market to have some cash available and to have groups where we've partnered like Sprott, who have a great deal of money, and even Lithium Royalty Corp. I think it's going to let us go out and get some deals where you might have a little bit of distress, might have a lack of capital to get in more accretively than you otherwise could in a normal market, and do some producing and kind of within 12 months production opportunities. So we're going to chase some of those down as well. I think that's going to be a really good space. We might be able to find some more accretive cash flowing deals than you would have been, say 6, 9, 12 months ago.
It's funny. It's almost as if the market isn't rewarding you for what you're planning to do in the future. It's almost as if you're going to have to, as you say, show them the money. It's the cash. It's just one of those tricky things.
Yeah, well, I mean, I know if you look kind of 5 years out, I mean, the best thing maybe is we just sit back and just say, let's wait, because if we get to our cash flow estimates from 5 years from now, it's a fundamentally different company, and that's all funded at no cost to us. And we've got enough cash. We could sit here and wait, we'd be cash flow positive. We just sit and wait, right? So, it's funny. It's we look at it, there's still opportunity out there that we can't miss. I mean, it sounds a little bit cheesy, but we do look at it like we're buying royalties on the oil fields of the future. You're talking about for manganese, there's one district, there's one kind of oil field, right, of manganese in North America. And we know it's going to be a very important metal moving forward over multiple decades. And we're the only guys really going in and excited about this stuff now. So it's just the opportunity is really too good to just kind of keep growing, keep adding these while we still can. Do
you think in hindsight, not in hindsight, but do you think there's a case for being private?
Well, yeah, look, honestly, I know what the groups that are private right now are asking in terms of valuation. And it's 10 plus 15x, plus us. I saw what a lot of these private portfolios were sold for recently, stuff that was 2-3x our valuation. I would have taken our portfolio in a heartbeat over these. So yeah, no, look, I mean, we went public in the middle of COVID, it was June 2020. We did it as a means to get capital at that time. And so that was it. And then the cat was out of the bag. It's been a helpful tool in us being able to use our shares as a source of acquisition capital. Although at these prices, it's harder to do. But yeah, no, look, hey, there was a couple of weeks ago, I was looking at like maybe we figure out how to go private here. Because the market is just, it's really not accurately assessing the value that we have here. And we have, discussions with these private equity groups. So we know what they're asking, we know what they're looking at. And, that Seymour Lake royalty sale, that was a good part of us trying to showcase to the market just what the real valuations are out there. Not just in our company, but what they should be.
Yeah, no, I mean, I think I've said it 3 times already. I'll say it a 4th time, that it's a really good precedent, and it gives you a good look through implicit valuation
it's not something that typically groups have done out there. So
no.
We're not afraid to do stuff to break the mold. We're mercurial, whatever makes sense, from a business standpoint, we'll do. I mean, I'm all in, right? I'm like, 98% of my wealth is in electric royalties. Myself and my family combined are, probably closing around 15%. We've had another major investor, Stephen. We just announced this morning. He's upped his ownership up to 13%. So just between a few very strong good shareholders, in Jackstock and Globex, we're closing in around 45%. So we've got a very tight ownership structure. A lot of good high net worth individuals in there. So hopefully, things are going to start to turn around here, and there should be some research hopefully coming out over the next kind of month here as well. And so that'll be exciting to see too, because there's a lot of things that hamstring us in terms of our ability to talk through numbers of ASX companies, because they don't have NI 43-101s online. We're a public Canadian company, and so there's a lot of things that we get hamstrung, but just having somebody go through, do the calculations, for all of our 20 assets, I think, it should be helpful as well.
Can you not do an asset? Can you not do a transaction on a JORC compliant resource? Does it have to be NI 43-101?
I can do an acquisition on it, but then if I want to do a press release talking about the economics, when they do a scoping study, a feasibility study, or DFS, I can't. And so that's really frustrating. And we do have most of our lithium assets are ASX operators. So it's been, that part's been very frustrating, because we have a good amount of value in those assets. And I can't tell you, hey, these are the production profile, even though you can go check it out on their news site. We're not allowed to put that in our news and our presentations. It's a challenge for sure.
Well, and the other good thing about having a tight shareholder register, presumably, is that volume is relatively light, so that when there is a buyer in the market, you can recover your share value quite quickly. I mean, it kind of
I think one of the we had a couple of sellers going against us for the last kind of 12 months. I'd say probably across 3 groups, there was probably about 12 million shares that have been selling, and part of that was we were using our share capital to acquire certain assets, and that was more of our ability to raise cash at that time versus wanting to get these deals done. It turned out to be very accretive, by and large, but some of those sellers have sold. I think we're finally through that. I think all the big sellers have finally sold out. We've, like I said, our ownership's really been consolidated, in very strong hands now. And so, I expect that, hopefully the market should start to re-rate us here as we move forward this year. And we're going to, keep adding good royalties. Like I said, we're going to be trying to add some more immediate cash flow, and the portfolio is going to do the rest for us as we move forward.
So tell me a bit more about your shareholders. I mean, how much is kind of retail, and how much can you identify as either family offices or institutions or insiders, friends, the wider friends and family?
Yeah, well, I just said, between those first 3 groups, including myself, my family, we're kind of at about 45%. I think I could probably target and identify we're close to 80, 85, 90% of our stock is at this point. And they're good hands, good high net worth individuals. We don't have a huge institutional grouping just yet, but part of that, like I mentioned, is we're not at the size level where a lot of these groups can start to play. So but it's a very good shareholding, very tight. As of today, we've only ever raised 10 million, right, or 10.5 million. We're going to have 8 million cash in the bank coming up here, and we've got 20 royalties. So it's kind of interesting to see how you get to there over the course of 2 years. But we're very happy with the acquisitions that we made. We're happy that everything has gone, actually, to be honest, much better than we ever expected. For several of the projects that we got into. So it's going to be exciting. No, look, we're very happy with the deals that we've made. I think a lot of that should start to unfold as, like I said, we've been around 2 years now. A lot of the assets we were getting into, we're expecting to be kind of 2-3 years from production. And so we're expecting a lot of that to start to pay dividends here for us. As we finish out this year, moving into 2023.
And the timelines have been okay. You haven't had much slippage. I know there's been COVID in the middle of this, but are you still 2 or 3 years away? Or I know we were just been talking about OTA, but the question is, has the moment of truth kind of just pushed out, or are you actually closer across a range of assets than you were?
Yeah, no, we are. So a lot of these assets have been moving ahead. We $1 billion now raised over the last 18 months, going in across our portfolio of assets. So they are moving steady progress. I'd say, you've probably seen a 3 to 6 month bump in certain cases, just from COVID over the last couple of years. We have going on in Ukraine right now, and inflation. I'd say there's probably been a 3 to 6 month delay in certain assets in terms of development, whether that's for financing availability or whatnot. But generally, by and large, no. I mean, all these assets we got into are steadily marching forward. They've had tons of money going into them. And so, that, like I said, we're expecting that to start to pay dividends here. In many cases, better than we expected as we move forward into 2023.
Brendan, thank you very much. What a treat. I've really enjoyed the catch up. And best of luck with the news flow and the project deliveries and the royalty dealings and everything else that you're up to in the coming months.
Well, I appreciate it, Marlon. It's always fun to catch up with you. And, thanks for going through our portfolio. I hope investors find it useful.